Good morning and happy Good Friday to you. My name is Matthew Buckley. I'm the Chief Market Strategist here at Wealth Creation Investing. Been a pretty crazy week that we're going to talk about. Kind of got whipsawed around this week. Quick disclosure though, access to this video or any webinars that WCI puts out are for educational, training, and informational purposes only. Make sure you consult a licensed broker or investment advisor before you place any trade, because trading involves risk. So neither WCI, any of our affiliates, respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker dealers. Folks, we're not implying any profit or guaranteeing any profit. As always, common sense. Do not trade with money you cannot afford to lose. And at WCI, we make all of our trades in a virtual paper trading account. And past performance does not equate with future results. And any results discussed in this video or webinar are not typical, and they're only as of that specific date. So let's go ahead and get started. So what happened this week? And this is the type of week that really gives retail traders whiplash. What happened? Well, earlier in the week, we had what? We had great unemployment numbers. Not great. Let's be realistic here. Anything unemployment above 8% is devastating the economy. But, other than that, Mrs. Lincoln, how was the play? But ADP released some good numbers for February to March on a seasonally adjusted basis. However, if you recall my brief from the beginning of the week, I said that there's two organizations that report job numbers. One of them is ADP. ADP is you don't see a .gov at the end of this, do you? Well, the government also reports job numbers, and guess what? Today had a bad jobs report. So obviously the market's gonna react on that. So the government came out with their numbers, and it kind of contradicts what ADP came out with. So that's always interesting, folks, is one set of data come out and say one thing, and another set say something completely different. Only 120,000 versus the 209 that ADP put forward. So that's pretty interesting. So always keep that in mind. And as we talked about in our Monday brief, you should always be taking a look at U6. Not U-Boat 6 that we probably sank in World War II, but on the Bureau of Labor Statistics.gov site, U6 is total unemployment there. We're seeing a good trend. It's going downward, but folks, 14.5% is just absolutely nuts. And I need you to go to this site and read really what U6 is. Because what's the number that politicians love to use? It's right up here. It's U3. And that's the official unemployment rate, which is full of BS. This is the real unemployment rate, folks. It's U6, and it's not looking better. But let's get I really want to get into what happened this week in the market and debrief that, because a lot of folks obviously go, all right, Wiz, what the heck happened? Well, let's take a look at our Trade Monster platform. And folks, you can use any broker you want. Obviously, there are a lot of great brokers out there, but we at Trade Monster, one of our strategic partners is Trade Monster. They have a great platform, really great rates, and I recommend you take a look at them. You can go to trademonster.com/WCI, and you can open a free paper trading, or what we call a virtual trading account, where you get some monopoly money, call it, some fake money, to really learn, because you should not heading out to the airplane without hitting the simulator first and really going through it and figuring out what you're doing. So let's take a look at what happened in the market. This is a chart of the SPX. And it broke that all-important psychological 1400 line. Everybody had their 1400 party hats on. But what happened this week? Monday, ADP, good numbers. Yay, the market rallies. And then what happened on Tuesday? Well, folks, what happened on Tuesday was the FOMC minutes came out. Now, those are minutes of the last Fed meeting. And what did they say? Or what did they not say? More or less, folks, they said no QE3. And unless you just landed from Mars, QE is quantitative easing. It's code word for the Fed chairman, the helicopter Ben, running the printing presses on overtime, adding liquidity to this market. Many of you out there in middle America, out there in Peoria, are wondering, why is this market going up? Well, folks, it's the gentle, invisible hand of the Fed, or as I like to say, the visible hand, pumping liquidity into this market. And guess what the bartender, Ben Bernanke, said on Tuesday in his notes? No QE3. So the market said, oh my God, it might be the end of free and cheap and easy money. Guess what, folks? If any of you pay attention to the market in detail, what happened when the Bernanke testified in front of Congress in early March? The same type of thing happened. He said no QE3, or actually he didn't say that, and that's how the market took it. When he testified in front of the House and Senate, he said he didn't talk about a QE3, so the markets took that to mean, closing time. He's saying last call here. And then the Fed chairman promptly went on a college speaking tour like Tosh O, and the market, and he said, hey, we're going to keep quantitative easing low until 2014 there. And the market, the treasuries, and some of the bond markets were pricing in a rate increase around sometime late in 2013. So to hear that he's saying, no, we're going to keep the spigots open till 2014 was great news. So why this pullback this week? Folks, the market has the attention span of a 5-year-old and a news reporter. So what do you mean no QE3? Well, that was old news, folks. So it's kind of a sell on the news type of moment this week. So we sold, about 2 days there of triple-digit losses, which, leave people with a black eye unless your portfolio is hedged. But by the end of the week, what happened? And also on Thursday, there were some, or Wednesday, Thursday, there were some, union strikes in Spain. Folks, Spain is not Greece. Greece has incredible debt problems with their government. Spain, not so bad. They're still going to need some austerity measures, but they're not as bad as a train wreck as Greece. So what happened? The market kind of found its footing towards the end of the week and actually started back with a little bit of an uptick. So just like we saw when the Fed chairman testified in front of Congress, hey, I'm calling the last call, folks, and everybody felt the hangover coming, the market pulled back and volatility spiked. Well, guess what? Same thing. We've seen this movie before. Let's take a look at volatility. Our altimeter, and this kind of runs inverse to the chart we just saw, right? We saw a nice downward trend, and then with volatility, we saw it spike. If going from 15 to 17 can be called a spike, well, and with the VIX it is actually, because it's at 16.5 right now. But folks, the volatility has never been cheaper, and something you're going to hear me pound the desk about at WCI is when volatility is cheap, you buy it. When it's expensive, you sell it. So that's kind of what happened this week. So the positions in one of the model portfolios I manage for one of our subsidiaries, Top Gun Options, is doing extremely well. We put on a gold iron condor this week. Our double vertical in USO is looking out. We have an earnings plan on Goldman Sachs coming out, and we have a long-term hedge on volatility with the VXX. So pretty happy with the primary intermediate portfolio over at Top Gun Options, which is up over 20% year to date, and annualized, those are some pretty good numbers. So folks, just a quick debrief on what happened this week and why, to keep you fully informed and educated at WCI. So I hope you have a great Easter weekend. Be safe, spend some time with the family, and I'll see you on Monday's weekly brief.